I think that's really important. That's why I spent some time talking to you about it. Okay, let's take a look at this question. So assume a firm spends 20 million on a new machine that is subsequently used in production. Show how all 6 of these criteria would likely to be met such that the machine would rightfully be treated as asset with assigned value of 20 million. Okay, so in this case, it's a machine, it's tangible, right? It's tangible. But these criteria, we can still use these 6 criteria for this machine. So let's take a look at A, technical feasibility of completing the asset, tangible asset. Is this fulfilled? So just change the intangible to tangible, okay? Because this is a machine. Yes, right? Because you have it there.
Yes.
It has been used for production, okay? Intention to complete the tangible asset and use it or sell it.
Yes.
Yeah. Yes.
Good?
Yes.
Ability to use or sell the tangible asset.
Yeah.
Yes.
Yes.
Yeah. How the tangible asset will generate probable future economic benefits, existence of a market for the output of the intangible assets, or if it's to be used internally, the usefulness of the intangible assets.
Internally used?
Yes, it is
Yes,
to be used internally.
Is there a market for this machine?
No,
It didn't mention.
Yeah, not sure.
Not sure, right? Is this new machine useful?
It says it's going to be used in production.
Yes.
So.
Yes.
Okay, is the usefulness, right? The usefulness. It is to be used internally, the usefulness of the tangible asset. Okay, so we don't know, right? Do we know this machine is gonna help you to generate revenue? It's gonna help you to make certain products that is going to be sold? Do we know that information?
It's going to be used in production, so it's going to help make products.
Yeah. But again, your machine is designed for producing something, right? But does that item have a market?
I guess you don't know entirely.
You need more information.
You know it's going to produce something, but you just don't know what it is going to be.
Yeah, you need more information, right? So again, here is about the future economic benefit, right? So it's unclear based on the information provided whether you know, this new machine is generating future economic benefit. You can produce things, right? If you produce fake masks, right? You can't fool people. You know, some of the Chinese manufacturing companies, they produced lots of like low quality masks, right? So some companies, they purchase all these things in a short time because they believe this is, you know, this is a place to get their wealth, right? It's too bad. Yeah, they only care about doing this so fast, but their product is low quality, right? Does not meet the standard. So you know, people all over the world, they know that, you know, this, they don't buy it anymore, right? So I guess, you know, something new does not mean it's good, right? It does not mean you have a market. So I would put a question mark. I understand why you think it passed, but because of the lack of information, I would really just put a question mark here, right? Availability of adequate technical, financial, other resources to complete the development, right? To sell, use it. Is this completed? Yes, right? the machine has been completed, developed. Ability to measure reliability expenditure attributable to the intangible asset. Okay, so do we know that?
Yeah.
What is that?
20 million.
20 million. Okay? 20 million. So you can see that, you know, this criteria can also be used for tangible assets, actually. Yeah, it's not just for intangible assets, right? It just, but do we have any questions on this? So this is very important. In the CPA exam, I know there is one case dealing with this when I was writing my CPA exam. So there's a reason why I'm willing to spend time on this, right? Because this is important stuff. You need to understand the definition of intangible asset, right? You needed to be able to know, okay, the internally developed asset, intangible assets, what are the 6 criteria, right, for the capitalization. This is very important, okay? Very, very important. Any questions? The way how you remember this is, well, first of all, you are concerned whether this can be completed, right? So that's A, are you capable? B, are you willing? And E, do you have enough resources, right? So A, B, E is all about, you know, is this item will be eventually developed, right? That's the ABE's concern, right? If it is a question mark, then you cannot recognize the asset, right? C, ability to use of sell. C and D is really about the market, right? Do you have a market, either to sell it, or do you have is useful for the internal, right? And F is the measurement, right? So, you know, the 6 point, it's also not too bad to understand, right? So if you follow my logic, it's easier to understand this. Is this helpful? Because this is really important.
Yeah, it's helpful.
Yep.
Okay. Yeah. Okay. Awesome. Okay. And then subsequent measurement. They could use either historical cost or revaluation model. So in chapter 10, I'm going to talk about what is a revaluation model. And then you're going to differentiate the intangible assets that has unlimited life versus finite life, okay? So the useful life, okay? The useful life. What is the useful life? That's the period of time the asset is expected to be available for use by the entity, okay? Okay, so what would be a good example for the intangible asset with indefinite useful life? So the example I gave here is the trademark. So in Canada, if you register a trademark, it's good for 15 years, but then you can indefinitely renew it, okay? So every 15 years you renew it, every 15 years you renew it. So that means it's kind of equivalent to a indefinite useful life, right? As long as you are willing to renew, right? You believe the trademark is valuable, you would keep renewing it, and then your trademark would be a indefinite useful life, right? The trademark will have an indefinite useful life. So in this case, you are not doing amortization, just like land, right? Land has unlimited years of useful life. You do not amortize, you do not depreciate land, right? Similar idea here, you do not amortize the trademark, okay? However, you do recognize the impairment, okay? If the fair value of your trademark declines, you have to recognize the impairment. Does this make sense?
Yep.
Okay. Okay, so what about the other category, the intangible assets with finite useful life? Okay, so in this case, the challenge is the assessment of useful life. Okay, so you are saying they have a limited years of useful life. So what is it? 6 years, 10 years, 50 years? How the management will make estimate, right? This is really complex. This is a challenge, right? So the useful life is generally speaking, useful life is the lesser of the legal life and the economic life, right? So let's take a patent, for example, right? Legally, maybe patent has 20 years of life, okay? So the patent is 20 years, the legal life, okay? And then economic life, what is economic life? It means, during the economic life, your patent is generating future benefits, right? So during this economic life, the patent is able to generate cash flows for you, right? So the two lives may not be the same, right? So patent, even though your legal life is 20 years, but your economic life can be much shorter, right? Because this is the technology advanced very rapidly. Your patent is outdated very quickly. Your technology secured by the patent may become obsolete in 3 years, right? So then you can only make money with that 3 years. We call it economic life, right? So your patent has 20 years legal life, but only 3 years economic life. So the useful life would be the lesser, which is 3. Does this make sense?
Yep.
Okay. Oh, okay. It could be the opposite, right? If your legal life is 3 years and the economic life is 20 years, right? So at the end of the 3 years, okay, the patent become publicly available. Okay. So then, the economic life 20 years does not mean anything because everyone can use it, right? It's not a secured cash flows for yourself, right? So then your legal life, your useful life is still 3 years. Is this clear?
Yep.
Yes.
Very good. Okay. So basically, when you are assessing the useful life, it's going to take some professional judgment. Okay. Sometimes we don't like professional judgment. You probably don't like writing the answers, the case answers, right? You feel that you were not given enough information. You feel that, oh, I have to make assumptions. I have to make an estimate. I don't like it, right? I wish it would be just like a math problem or physics problem. I have all the information and I will come up with a number, right? But that's not the real life, right? The real life is, somebody just walking into your office, tell you a lot of things, right? Informations. And often, most of the time, you don't have a perfect information. You have to use your professional judgment. And that's why CPA is paid with the big bucks, right? Because you use your brains, right? You use your judgment, right? If your work can be replaced by machine, then we are not valuable, right? They will not pay us good salary, right? So we should embrace professional judgment. That's why you got paid with a good salary. So don't feel too bad about it, okay? So in practice, nearly all firms amortize intangible assets using straight line method with no residual value, right? At the end of the useful life, what's the value of your intangible asset? 0, right? 0. It will be not useful to you. It will not be useful to others, right? Does that make sense? So residual value is 0, and they use straight line method. So this is kind of the common way for the companies to amortize the intangible assets. Do we have any questions?
None, it's pretty clear.
Okay, good. Thank you. Okay, so let's take a look at this. Okay, see if you got this. So identify whether the following items have finite or indefinite lives. Okay, here. First one, okay, make sure participate, okay? Make sure participate. and make sure you send me email after this lecture, okay? A copyright.
Finite life.
Indefinite life?
Finite.
Finite life?
Finite.
Okay,
Indefinite.
okay. So this one is finite life. So the copyright, you already have maybe a life of the author plus 50 years. So recently in US, Disney companies is lobbying the government to change the law to extend the life of copyrights, right? Because at the expiry of the copyright, you know, protected items will enter into the public domain. Okay, so then Disney will not make that money, right? Will not make as much money as they could. So therefore, this one is called this lobbying is called the Mickey Mouse Protection Act. Okay, they try to delay the advancement of the protected items into the public domain, right? So before it's like 50 years, like the life of the author plus 50, or maybe plus 75 or plus 90, right? So the lobbying work from this, you know, industries, right? Entertainment industries, like movies, right? This type of, you know, they are trying to delay this, delay the useful life of copyright. So copyright has limited years of life. Okay, does that make sense?
Yes.
Yeah, but
Yes.
Disney doesn't like it, right? Because I think Disney, the first one started in 1921. So if you using this rule, I think by 2024, you know, Disney's some of the copyright will enter the public domain. That means if I have a product, I can use this Mickey Mouse, okay? This logo, this picture of. Right now, if you use it, if it's commercial items, you have to pay, right? Right now, if you develop, let's say, if I'm selling a cap, right? I decided to put this logo, like the Mickey Mouse on the cap. Well, you better talk to Disney, okay, about the copyright of the image, right? But if by 2024, okay, then everyone can use it, right? So the copyright has a finite life, okay? But like just for your information, the entertainment industry, they keep lobbying to extend, delaying this process, okay? What about the trademark?
Indefinite.
Definite, right? Trademark. Think about what would be a good example. Do you know that logo of the Raptor, the basketball team, Toronto Raptor, right?
Yeah.
That's the trademark, right? So when you see that picture, you know that's the Raptors, right? Then you think about the glory of winning the championship in 2019, right? Yeah, 1 year ago, right? First time. So yeah, so that's the trademark, indefinite useful life. Brand purchased from another company.
Indefinite.
Indefinite, right?
Indefinite.
Definite, right? So Google purchased the YouTube, right? That YouTube brand that belongs to Google forever, right? D, design for an office chair, industrial design.
Finite life.
Finite.
Pattern.
Okay, this one has a legal life of 10 years, okay?
Design.
Industrial design has a legal life of 10 years, okay? So it is finite life. Accounting goodwill.
Indefinite.
Indefinite.
Yeah, very good. Okay, so for the items with limited years of useful life, what are we gonna do? We have to do a amortization, right? Every year we amortize this, possibly straight line amortization with no residual value, right? What about the other items with the unlimited years of life? Come on.
You don't do.
Yeah, you don't do amortization, but you do something.
You do the impairment.
impairment test, right?
Oh.
Do impairment test. So make sure you are able to distinguish this, right? So you, for those goodwill, trademark, you still have to check the value, fair value for the impairment test. Okay. Are we good with this question?
Yes.
Yeah. By the way, I'm 39 years old this year. I watched the Mickey Mouse. That's my first cartoon in the 1980s when I was a kid. At that time, there's no cable. People use those post with it's really, really old technology. You probably don't know what I'm talking about. So you set up a post, and then you set up antenna on top of the post, and then you set it up. You are hoping that your post is high enough to receive signals, right? I was very upset if the signals was not good because I cannot watch the Mickey Mouse. So, do you know what I'm talking about? The system.
Talking about rabbit ears?
The post with the antenna. What is it called?
Well, you could put the rabbit ears on top of your TV also, right?
Okay, but
Two
I'm talking
antennas?
about this is like a 2 meter or 3 meter long, like a wooden stake, and
Oh,
you
you
set
mean
it
that
up.
one on top of the roof?
Yeah, on top of the roof, or you set it up outside, right?
Yeah, we had that before.
Yeah, and you only get 3 channels. Boy, those yeah, no,
Yeah,
not
sometimes you even had to put your hand on there to get the good,
yes,
right?
yeah. Okay, well, I think most of you probably don't have that kind of experience. It's all cable right now. So, okay, so we are good with this. Derecognition, very simple. No difference from the tangible asset. You dispose it or you sell it, you debit cash, okay? And you're gonna close the asset accounts related to the intangible asset. So you credit the cost account and you debit the cumulative amortization account, okay? And if you need additional debit, that's a loss. If you need additional credit, that's a gain. And this goes through the income statement. Any question? By now, you really should know this because I taught this journal entry many, many times, okay? Are we okay with this journal entry?
Yeah.
Mm-hmm. Okay. Okay, goodwill is the difference between the purchase cost of a business and the fair value of the identifiable asset net of liability. We did a question, we already know this. So we don't need to amortize goodwill because it has indefinite life. Goodwill is evaluated for impairment, okay? No amortization, but has to go through the impairment test. Okay, presentation and disclosure, okay? Instead of going through these items, I'm going to show you one of the company reported the success of the COVID-19 vaccination. So I thought, well, what's the best way to show you this presentation disclosure? Maybe I can show you their financial reporting for last year, okay, 2019, okay? So let's take a look what it looked like. Okay, so for this one, okay, which is the first one I want to show you? Okay. Are you able to see this PDF?
Yep.
Yep.
Okay. So let's take a look here. Okay. So now you see this is a Pfizer Incorporation. That's the company declare a 95% success rate, okay, for COVID. For this company, did you see here? This is the income statement, okay? This is the income statement. And the next page is the comprehensive. Remember, there are two steps, right? 2 components. One is the income statement. The other one is the comprehensive income, right? So if you take a look, that oh boy, this is audited by KPMG. Okay, so KPMG New York, right, audited this company. So if you take a look at here, did you see research and development expenses? Are you able to see that?
Yep.
Yeah, I see it.
Okay, and how much is that? Is 8650, and you compare to the revenue. Okay, compare to the revenue. Revenue is 51, right? And this expenses is 8. That's 16% of the revenue. 16% of the revenue goes to research and development expenses. Okay. And also you can see that the amortization of intangible assets, right? The amortization of the intangible assets.
Yep, I see it.
That's also the cost. Okay. So basically, in the financial statement, you have to disclose the amount of the R&D expenses, and through the profit and loss, right? Through the income statement here. And you also need to separately report amortization of the intangible asset. Okay? So now you know where this is coming from, right? Okay, so this is one. Okay, so now take a look at balance sheet item. Okay, balance sheet. Did you see Goodwill? Okay, here.
Yep.
So Goodwill is presented under the intangible assets, right? Okay.
Yep.
So you can see that they presented the PPE, that's the tangible asset, and they reported the net carrying amount book value, because this number is the PPE less cumulative depreciation. And now they have intangible asset, right? It's less cumulative amortization. Right? You see the difference between the wording, depreciation and amortization, okay? And it's interesting, take a look at this. So the asset, total asset is 167. How much is for Goodwill? A third of that is Goodwill, okay? So this company has purchased a lot of other companies, okay? And the intangible asset, 35, that's 20%, right? That's about right, because this is a pharmaceutical company, right? So 20% of their total asset is intangible. That's about right, right? Right?
Yeah.
Yep.
Okay. So it's good, right? If you take a look at here, you learn about the cash and the cash equivalent. You deal with account receivable, right? And you learn about the inventory. You are learning this in chapters, maybe next course. You know about asset held for sale, right? Equity method investment. This is about associates, right? Associates, when you have a significant influence. Chapter 7. Long-term investment, right? So PPE. So yeah, we're almost done, right? You can see we covered this whole assets. We covered the whole asset section, right? And in 3101, you are going to learn the rest of this, right? You're going to learn the rest of this. Some students ask me if I will be teach the next course in spring. I will not, okay? I will teach this course again, 3100, and I will teach 2100, okay? Okay, so this is the liability. Let's take a look at the notes, okay? Here, this is a note to the disclosure. So they use the, okay, the weighted average life for each of our total finite lived intangible asset, and largest component is the developed technology rights is approximately 9 years, right? The useful life, 9 years. Okay, so let's take a look at this. Is the font size okay? Are you able to see it clearly?
Yep.
Okay, good. So here they have a notes, right? For the, they have a note 10 just for the intangible asset and the goodwill. So there's one note, and you can see how long the note is. So they are saying you have to, for intangible asset, you have to disclose amortization policy, carrying amount, cumulative amortization, amount of amortization. Okay, you can see in the notes. So they compare the 2 years, 2019 versus 2018, and they report carrying amount and the cumulative amortization, right? So they separate the two class, finite life intangible versus infinite life intangible, right? You want to separate the two classes. And here, you have developed technology rights, brands, licensing agreement, and other. Okay, so that's interesting. If you read this footnote A, so the increase in the gross carrying amount of the identifiable intangible asset reflect the impact of acquisition of ARI. So in 2019, this company acquired this company ARI, okay? And so they acquired their intangible asset, $1.8 billion of developed technology rights, 340 million of the licensing, and 4 billion of the R&D, 1.1 billion of the licensing, right? So it's, and also there are impairment, because partially of this change is offset by the intangible asset impairment charge, okay? So there are some of these rights has been impaired. They recorded the impairment, okay? So it's quite interesting, right? So for brands, some of the brands have finite life, others have infinite life. They have very, very good explanations. Okay, take a look at this, okay? They would tell you about developed technology life. What are they? What are the brands? What are the research and the development? What are the licensing, right? So in the notes, they provide a lot of good detailed information, right? Good detailed information. So here, okay, I want to show you something here. Okay, so this is very interesting here. So this asset, okay, this asset, R&D, that's the research and development, right? Represent asset have not yet received regulatory approval in a major market, okay? The significant component of this include this asset acquired, okay? This significant portion of this is acquired in connection with this acquisition, okay? So it's carried from this company. And it just keep going. Is classified as indefinite life asset until the successful completion or abandonment of the associate RD effort. So right now, they just keep it because this is the acquired asset, right? They just keep it as a indefinite, as a intangible with indefinite life until further information is cleared, right? If it's a successful completion, then you are going to do the amortization, but you have to first estimate the useful life. Or if the R&D turned out to be unsuccessful, you have to abandon the project and you have to expense all the cost, okay? So that's what they are telling us here, okay? That's what they are telling us here. So at that time, we will determine the useful life of the asset, okay? Reclassify the asset and begin amortization. If that's abandoned, if the effort is abandoned, and this will be written off, okay? And you're gonna record an impairment change, okay? So this is quite interesting, right? By reading all this stuff. So do you find, I have already posted on the Moodle website. I just want to give you one example. I think, you know, I really appreciate their work of doing the vaccination. So I thought, well, I'm gonna take a look at their financial report. So basically, a lot of this talking is about, you know, we have seen, right? We just have seen this. Do you find that helpful by reading that report?
Yeah, it's nice to have real life examples.
Mm-hmm.
Yeah.
Intangible eyesight is kind of tough to teach. You know, when I talk about PPE, right, it's easy to have a picture. So, but I'm glad we have this vaccination example. I think it makes it more interesting. Yeah. So we are done with this. Okay, so let's see how we are doing this time. So for mineral and government grants, I don't want to talk a lot about it. I just want to highlight something you may want to know, okay? In the future, you probably will learn more about it. So for mineral resources, okay, there is the IFRS 6 addressing these specific issues about the cost incurred when you explore, right? When you you know, evaluate the potential mineral resources. Okay, there are three. You can see three phases, right? So first, you want to find out where I can mine, right? Where I can mine. Where are these oil sands is, right? As an Albertan, right? We are proud of our oil sand, right? So you can see the picture here. Alberta proud, okay? I'm really proud of Alberta. So for example, you know, oil sand, right? Think about oil sand. Well, first we had to find where are these oil sands, right? So you're gonna explore the land, right? Using some geophysics technologies, right? Infrared kind of whatever detectors just to check huge concentration of the mineral, right? Whatever the oil sand stuff. So, and then, you know, do you have the technical ability to take out the oil, right? Because it's not just the liquid, you can pump it out, right? This is oil sand. You need to have a special, maybe what you guys have better knowledge about how they treat the oil sand, right? They have environmental concerns, and procedurally they have to kind of use water. I don't even really know what is happening, but they use water, and somehow that's the way they can separate, you know, from the sand. I don't know what exactly that happened, but it's a technology, right? It's a technology involved. So, and you know, is this, you have to first have this evaluation on the site and explorations, right? And then you start setting up your machines. And then you start, you know, starting extract this resource, right? And then this is the preparation stage, and then it's ready. You start to have the production, right? So IFRS 6 is for the first stage, okay? IAS 38 that deals with the development phase, and for extraction, when you start producing the crude oil, that's the stage of extraction phase, and all the costs will be expenses, right? Okay, so for the first stage, okay, similar to the research and development, right? There are significant uncertainty, okay, in the first stage when you explore, evaluate the site, okay? You are not sure if there's enough mineral resources, right? And you are not sure if you are able to extract those resources, right, using the existing technology, okay? So lots of uncertainties in the first stage. So IFRS 6 allow both, okay? You can choose to expenses all the exploration cost, or you can capitalize all the exploration cost. Okay, is this clear?
Yes.
And then when the project enters into the development phase, okay, so you are going to deal with the accounting treatment, okay, accounting treatment. It's called the successful effort method. That's the method IFRS requires. Only costs related to discovering valuable minerals are capitalized, okay? If it turned out to be successful, the cost, related to discovery will be capitalized. So it's interesting. I don't know if you guys know. So a couple of years, maybe many years ago, some of the companies, they explored the land on the west side of Lethbridge, okay? And they know that there are huge amount of oil under the ground on the west side of Lethbridge, right? And I think the company even received the provincial approval for the mining. Do you know that? And then the people on the west side were so upset, right? Because once they start digging, the property value will go down, right? The houses on the west side, a lot of the houses are new houses. Some of the houses maybe cost $400,000, right? So the homeowners were really upset, right? Because once they start extracting the oil, the property value on the west of Lethbridge will decline, right? Because it's not ideal for the habitation, right? You don't want to live close to that extraction site, right? Does that make sense? So they are protesting. They just don't like the idea, right? And eventually, but because they receive approvals from the government, Alberta, right? But the city of Lethbridge has invested heavily on the west side, right? They build a library, they build that big gym center, right? They invest a lot of money on the west side, and they don't want this, the extraction ruined all this plan. So the city of Lethbridge would say, guess what? I'm not going to support you the water. I'm not going to support you the power. Well, you get a provincial approval, but as a city, I have the right, I have the authority to decide whether I'm going to provide you the power, the water, right? So that plan didn't carry out. So I think people on the west side of Lethbridge is very happy, right? So you think about that company, right? They did all this initial exploration work, right? They tested, they know there's enough sufficient resources under, right? It's feasible technologically and visible, it's viable commercially, right? So it passed the first stage and they are ready to move into the second development stage. And that was stopped, right? That was stopped. Then too bad, they have to write off, all the cost, right? They have to write off all the cost. So when the project enters extraction phase, so they prepared all the equipment and set up everything. They're ready to dig, right? Then there are two methods. The successful effort method, okay, will capitalize cost of mineral exploration and evaluation only if the outcome is successful, okay? So under this method, okay, if the outcome is successful, you can capitalize the cost, okay? The full cost method, so IFRS allows to use the full cost method, okay? So that will be, will not depend on the outcome. Okay, so here is the full cost alternative under SB. So this is the method. We're not going to do a problem, and I'm not going to test you in the final exam. This would be just for your knowledge, right? You know something about the full cost method versus successful effort method. Okay, So this is a method of accounting capitalized cost of manual explanation and the evaluation cost without regard to the result. Okay, so even the outcome is not successful. Okay, you know, is, you know, you still can capitalize the manual exploration. So ISB allows private enterprise to use either the full cost method or the successful method. So just for your knowledge, for now, just knowing that for this manual particularly issues, there are two methods, and the IFRS you only use successful effort, and the ISB you can use either the full cost or the successful method. Okay, that's the two choice. Okay, again, subsequently, you can either use historical cost model or the revaluation model. So you need to evaluate for the impairment testing, okay? And depletion of manual explanation cost, normally use the unit of production method, right? So when you are, you know, amortize. So again, amortization is the word for intangible asset. But for manuals resources, there's another word called depletion, okay? So you have learned three: depreciation, amortization, and the depletion. So depletion here of the manual often normally is based on the percentage of use, right? The units of production method. If you estimate there's 100 tons of in the reserve, and you have extract 10, so then you should have 10% of depletion, right? 10% of depletion. So I'm just like really quickly going through this topic. Do you guys have any question?
No, all good.
Good, okay. Government grant. So government grant means you receive money, right? So government will provide assistance, right? So you receive money, you debit cash, right? You debit cash. And then what do you credit, right? That's the question. Can you tell me what accounts have normal credit balance? What accounts have normal credit balance? Participation, please.
Liabilities, equity.
Liability, okay. What else?
Liabilities.
Revenue.
Revenue?
Income.
Yeah, income,
Gains.
revenue.
Gains.
Gains, yeah.
Retained earnings.
Return earnings. Return earnings is part of the equity, right? Equity.
Yeah.
So you can think about this, right? It's basically this is our accounts, right? So if you say it's a liability, it means you have to pay the government back, right? But this is a government grant. They will not expect you to pay back, right? So it's not a liability. Now what left is this income or this is equity, right? That's the two alternatives, right? So are you going to record a grant as equity or as income, right? And at what time you should recognize this grant, okay? And there are expenses involved, right? You receive the grant, you are going to do something using the money. There are expenses involved. Maybe you hire an assistant, you buy some equipment, right? So there's cost involved. Are you going to present the gross grant or the net grant, right? So those are the major questions when you're talking about government grant, okay? So if you use a direct approach, right? Direct approach, basically you you transfer the grant to equity capital directly. That's called a direct capital approach. So you recognize that as equity. Grant is not a part of the earning process. It goes to the equity directly. In the first case, right, you remember there are some government grant, right? We have to discuss whether it's the income or it's equity. Do you remember case 1 about that penguins in paradise, right? They are making this product, right? And then the government, the Canadian government will give a grant, something like that. So the direct approach means you just, record the money received as equity directly. That does not go through the income statement, okay? Indirect approach is also called the income approach. So you have to earn this grant, okay? This grant has to be earned because the company need to satisfy certain conditions to receive the grant. For example, in your film, in your play, you have to have at least 50% of Canadian content, right? Maybe you have a geese walking across the stage, right? Put a beaver or something in the pond, right? So this means you are earning that grant, right? You are earning that grant. So if you are earning the grant, you made the effort to earn it, then it's income, right? Do you know like anybody in the class from India? Your home country is from India? No? Okay. So Bollywood, right? The film production in the Bollywood, they have to have a certain percentage of content of the Indian culture in order to be shown in the Bollywood filming, right? So I'm not sure how many of you watched the movie. So you would see people singing and then dancing, right? The part of the Indian culture, right? So every movie almost from Bollywood have a very heavy element of those, right? So again, similar ideas, right? Maybe the government, if there are conditions in terms of your production, there's conditions you have to satisfy. You are earning it, right? You have to satisfy the condition. Then it's the income approach. IFRS require enterprise to use income approach. Okay, so IFRS want us to use the income approach. Recognize government grant as income. Okay. Okay. So the recognition of the grant, you want to think about it. First, are you complying with the conditions of the grant, right? If you don't comply, then you won't receive it, then don't recognize it, okay? And then are you gonna expect it to receive that future cash flow, right? Are you gonna receive the grant? Will the grant be granted, right? So those are the things, right? We think about recognition, right? If you know for sure you complied with the condition, you satisfied all the condition, and the government have the money set on side for you already, then you should be comfortable to recognize the grant, right? But otherwise maybe your project is approved, but guess what? COVID came, government don't have that money set aside for you, right? So too bad, that grant will be delayed, right? You should not recognize it.
So are you saying that you can recognize the grants before you actually get them if you know you will receive them?
I think it's really depending on the nature of the grant, okay? We are not using cash-based accounting, so it's not really about when I receive the cash, right? I recognize it, right? So, and normally you have to apply, right? You probably have to apply, and it's safer to get approval from the institution, right? Then by that time
Then you'll know.
Yeah, it's a little bit maybe a little bit too aggressive. You believe that you are qualified, right? And then I think maybe we should be more conservative. When you do all these cases, right? Did you realize that the tone is really about being conservative, right? You have two approaches, right? In terms of revenue recognition. In case 2, you can recognize it as soon as you pour the lubricant into the machine, right? Or you can recognize it when they actually use your lubricant, right?
Yeah.
So you discuss that two alternatives, and you kind of suggesting both are reasonable, but the most conservative approach is defer revenue recognition, right?
Yeah.
So I think this would follow similar ideas, right?
Okay.
You are, you have to try to defer this kind of revenue recognition, right? Yeah. Very good question. And then gross method versus net method, right? Versus net method. So, for example, right, if you have a grant to do research, right, for example, and then I hired a student. So the grant is 20,000 as income, right? And I pay a student 20,000, right? No, sorry. The grant is 10,000. I pay the student 2,000. Okay. So you can present it in the gross method. So you're gonna show the revenue, the grant revenue, 10,000. You're gonna show the salary expenses, 2,000, right? That's the gross method. You can also use a net method, right? Using, instead of two lines, you only use one line. That's the net amount, which is 10,000 minus 2,000, 8,000 income. Okay, does that make sense? That's the difference between the two methods, gross versus net. Does that make sense?
Yep.
Hello? Okay, IFRS allows both. IFRS allows both the gross or the net method. Okay? Repayment in a government grant. If the enterprise is unable to meet a requirement, they must repay the grant. Okay? So accounting treatment is the changes in estimate. Okay? We use prospective treatment. Okay? Potential earnings management. So capitalization of development cost, right? So basically, if you do not capitalize your cost now, okay, so you are going to run all the costs as expenses. So your earnings will be underreported. And because you undercapitalizing, your asset will be underreported, okay? Your asset will be reported. So it feels like you really get a hit now, but in the future, if you have a good intangible asset, the income's earnings will be good, right? Because you don't have amortization in the future. So if I'm a new CEO, okay, I'm going to use this approach called big bath, right? Big bath. I'm going to run a lot of expenses, okay, to make my earnings very bad. And I can blame on the previous CEO, right? It's not my bad. I'm just taking over, I'm new. So this bad income is because of the previous CEO, right? Right? So you run through all the costs, okay, blame on the previous CEO. And next year, right, you don't have any expenses, right? You don't have amortization, okay? So then you have good earnings. Oh, now it's my good work, right? I did a good job. Estimate useful life of intangible. This is very tricky, right? The valuation will affect the amount of amortization, right? Okay, that's gonna affect your earning. So what is the determination of explanation success or failure? Okay, at what point you are saying we are successful and we failed, right? Because efforts require using the successful effort approach. So under that approach, it's important to know the outcome, whether it's a success or failure, right? So you can see there are rooms for earnings management, right? Earnings management. Okay, so I already talked about the difference between IFRS and ISB. Okay, so I'm not gonna repeat again. Basically, manual explanation cost, IFRS only use successful effort method. ISB, you can use either successful effort or full cost effort. Okay, that's it. So, do you guys have any question?
I can't think of anything for what it's worth.
Okay, so make sure, okay, for the intangible assets, that's the most important part. Okay, you're gonna see for sure. I think for sure there's gonna be some questions about intangible assets, about the 6 criteria. Okay, I hope by this lecture you will have a good grasp on that. Okay, so how should I deal with? Okay, here.
Hi, Dr. Liu. I do have a question.
Okay. Oh, sorry. Just give me 1 second. Did I?
Okay.
Just give me one second. Okay. So